The story begins in the early to mid-19th century, a moment when the United States was still a young republic trying to define its place in a world dominated by European empires. At home, America was industrializing, laying railroads, expanding banks, and building the commercial class that would later shape its economy. Abroad, however, global trade revolved around Europe, while Asia supplied the high-value goods, tea, silk, porcelain, that elite consumers demanded on both sides of the Atlantic. Into this world emerged a question that would reshape American fortunes. How did U.S. merchants, companies, and family-run trading houses insert themselves into long-distance trade networks normally controlled by Britain, France, and other colonial powers? This wasn't simply a tale of adventurous sailors. It was the rise of a structured economic system, one with clear incentives, defined choke points, and massive profit potential. The topic matters because the United States was hungry for capital. The country needed money to build rail lines across the continent, expand banks in major cities, and finance the rapid urbanization of New York, Boston, and Philadelphia. Domestic markets alone couldn't supply that capital. American traders needed higher margins, and global commerce, especially in Asia, offered them exactly that. Their participation would later influence which families gained wealth, which institutions were funded, and which cities emerged as economic centers. Globally, Europe controlled most key ports, but the United States held an edge that few anticipated: the fastest clipper ships on Earth. Without colonies in Asia, Americans relied on speed, efficiency, and clever navigation through restrictive regulations. Asian governments limited foreign trade, European powers guarded their monopolies, and silver, the backbone of international payment, flowed unpredictably between continents. These constraints didn't stop American traders. They created opportunities. Gaps in enforcement, mismatched regulations, and high demand in Chinese markets opened doors that U.S. merchants were eager to walk through. Of course, there were barriers. Many goods were heavily taxed or restricted. Asian authorities monitored foreign traders closely, and cultural expectations about fair trade and moral conduct varied widely between nations. But American firms learned to work with intermediaries, adapt to regional rules, and exploit price gaps between Asia, Europe, and the United States. This era would elevate a set of American families and companies that became pillars of U.S. finance, education, and industry. To understand their rise, we must first understand how the trade system they entered actually worked, its supply chains, its maritime routes, and the mechanics that turned global commerce into American capital. When we trace the mechanics of 19th century Trans-Pacific and Indian Ocean trade, we find a system far more organized and calculated than most people imagine. Goods originating in South and East Asia moved through a tightly coordinated supply chain. Purchased from local producers, processed or repackaged at coastal depots, loaded onto foreign ships, and then funneled through intermediary ports before reaching consumers in Europe and the United States. Local suppliers, often deeply embedded in regional economies, handled the early stages, while Western merchants provided capital, shipping, and access to global markets. Because rail infrastructure across Asia was limited, everything depended on the speed and reliability of ocean transport. The lifelines of this commerce were the maritime routes connecting Calcutta, Canton, and Singapore with New York, Boston, and London. Canton served as China's primary foreign trade hub. Calcutta was the British Empire's major collection point for Indian goods. Singapore emerged as a strategic refueling and redistribution center. New York and Boston became the American gateways, funneling Asian imports into East Coast markets and reinvesting profits into U.S. finance and industry. These routes were profitable but perilous. Storms, piracy, and shifting political rules constantly threatened cargo. Meanwhile, London and New York grew into financial engines, providing credit, insurance, and settlement systems that kept the entire network functioning. American traders entered this system at every stage, buying directly at source, transporting goods across oceans, acting as brokers between Asian merchants and Western buyers, and distributing the cargo once it reached the United States. Unlike their British counterparts, Americans had no imperial bureaucracy supporting them, so they relied on speed, flexibility, and informal partnerships. They built relationships with Chinese, Indian, and Southeast Asian intermediaries who handled translation, negotiation, storage, and local coordination. Services essential for navigating unfamiliar legal and cultural landscapes. The American advantage came from technology. Clipper ships, lightweight, tall-masted vessels built in U.S. shipyards, were the fastest sailing craft of their era. Their speed shortened voyages by weeks, sometimes months, which accelerated capital turnover and allowed American traders to undercut European competitors. Low operating costs and skilled American crews further boosted profitability. Payments, however, were complicated. Asian trade revolved around silver. U.S. firms relied on London banks, Indian agency houses, and American financial institutions to issue credit, insure cargo, and manage currency risks. Fluctuations in the global silver supply created both instability and opportunities for savvy traders to exploit price gaps across continents. Behind the profits lay substantial danger. The threat of seizure by local authorities, volatile commodity prices, high insurance premiums, and complex taxation systems. Many merchants skirted local regulations by trading offshore, using small boats for ship-to-shore transfers or routing transactions through neutral ports. At its height, dozens of American ships operated along these routes each year, moving cargo worth millions of dollars. This system laid the economic foundation for several American families who would later become powerful financiers, industrialists, and political figures. The natural next question is, among all those who joined this global trade, which American actors shaped its direction most profoundly? When we look at the American families who first entered Asian trade in the early 19th century, we're looking at a generation of merchants shaped by New England's maritime culture. Boston Brahmins, Salem shipowners, and coastal trading houses whose livelihoods depended on long-distance commerce. They were uniquely positioned to reach markets thousands of miles away because they combined seafaring tradition with access to capital, shipyards, and international connections. By venturing into Asia, they laid the foundation for the United States' earliest commercial presence across the Pacific. Their biographies share similar patterns. Young men who began as clerks or junior partners in coastal firms learned accounting and navigation and eventually earned opportunities abroad. Their motivations were clear. Asian trade offered margins far beyond anything available in domestic markets. Many belonged to families already engaged in shipping or finance, giving them both the skill set and the credibility needed to take risks overseas. What distinguished them was not privilege alone, but the ability to translate maritime expertise into global strategy. To access Asian markets, they developed sophisticated entry plans. Some opened offices in Canton or Calcutta, others sent representatives to negotiate directly with British and Indian intermediaries. They partnered with Hong merchants, hired local brokers, and built trust networks that helped them operate within legal systems designed to limit foreign actors. In these complex environments, adaptability mattered more than muscle. American merchants excelled because they learned the rules quickly and learned how to work around them when necessary. Their early investments were substantial. They acquired or chartered fast ships, leased warehouses, and established supply depots at strategic ports from Singapore to Macau.
These fixed assets allowed them to stabilize operations and shorten turnaround times. Over time, key milestones, new partnerships, market openings, the launch of faster vessels propelled them from regional traders to significant players in trans-Pacific commerce.
As their influence grew, they expanded not just geographically but financially. They adopted modern tools such as marine insurance, credit instruments, and bills of exchange. They opened new routes, coordinated with other American firms, and established benchmarks for logistics and contract enforcement. Their most profitable voyages, measured in tonnage and silver returns, allowed them to build the capital that later shaped railroads, banks, and insurance companies back home. This wealth did not stay at sea. It flowed into American cities, funding real estate in Manhattan, underwriting rail expansions in New England, and supporting early financial institutions. Their networks included agents, legal advisors, ship captains, and family alliances that spanned continents. Through these ties, they influenced not only trade flows, but the emerging identity of the United States in East Asia. Compared with other American families of the era, they succeeded because they combined risk tolerance with organizational discipline. Some rivals lacked capital, others lacked connections. These pioneers mastered both. And yet, they were only the beginning. Other families and firms soon followed, each leaving their own imprint on America's expanding global footprint. When profits from American trade in Asia flowed back across the Pacific, they didn't simply enrich a handful of merchants. They reshaped the economic geography of the United States. Much of that capital landed in cities like New York, Boston, and Philadelphia, where it was immediately reinvested into land, warehouses, and commercial districts. These returns arrived at a moment when the U.S. was industrializing at breakneck speed, and they provided the liquidity that young industries desperately needed. What began as overseas commerce quickly transformed into the funding mechanism for America's rise as an industrial power. With newfound capital, merchant families diversified aggressively. They purchased shares in regional banks, established insurance firms, and helped finance early rail projects that linked the eastern seaboard with the interior. Some families became major landowners in Manhattan. Others built port facilities in Boston or supported factory development in New Jersey. These were not speculative moves. They were strategic investments designed to convert maritime wealth into long-term domestic influence. As urban populations surged, this private capital accelerated the growth of American cities. Investment funds supported new public transit lines, expanded harbor infrastructure, and financed the construction of mills, bridges, and shipyards. The modernization of American cities was not solely the work of government. It was fueled by merchant fortunes shaped thousands of miles away. Education also transformed. Endowments created from trading wealth built libraries, science halls, and scholarship programs at Harvard, Yale, Dartmouth, and other New England institutions. Private money shaped America's intellectual infrastructure just as much as its economic one. Universities became beneficiaries of a global trade network that most Americans never saw. These fortunes also seeded the rise of major financial institutions, banks, insurance companies, maritime underwriting firms that set national standards for accounting, contract law, and corporate governance. Family alliances formed through marriages and business partnerships created an interconnected financial elite whose influence stretched from Wall Street to Washington. That influence extended deeply into politics. Wealthy merchant families funded campaigns, shaped tariffs, supported naval expansion, and held roles as governors, senators, and diplomats. Their interests aligned with a more outward-facing America, one that demanded access to global markets and pushed for open trade in Asia. To cement legitimacy, these families invested in museums, libraries, opera houses, and monumental architecture that still define American cities today. Philanthropy softened their public image, and reinforced a transition from international traders to respectable industrial capitalists. The result was the creation of a distinct American elite, educated, influential, internationally connected, and deeply tied to the nation's early expansion. But as America prospered, the question looms: what did this same commercial system mean for the societies on the other side of the Pacific? When American merchants expanded their presence in Asian trade during the 19th century, the economic consequences on the other side of the Pacific were profound. Asian economies, especially China and India, faced an increasingly unequal balance of trade with Western powers. Large outflows of silver destabilized monetary systems, strained government budgets, and distorted local prices. Historical estimates show tens of millions of silver dollars leaving Asia in just a few decades, undermining tax revenue and weakening purchasing power across the region. Asian governments reacted by tightening regulations, issuing bans on certain goods, restricting interactions with foreign ships, and creating new oversight institutions to monitor trade. Their goal was straightforward: protect state finances, cultural stability, and internal security. But these rules proved difficult to enforce. Western merchants, driven by profit and backed by faster ships, often bypassed regulations, leading to constant friction between imperial courts and foreign traders. Attempts to curb illegal commerce escalated into large-scale crackdowns, with local authorities raiding warehouses, confiscating shipments, and punishing intermediaries. Yet corruption, local patronage networks, and the sheer scale of coastal trade made enforcement uneven. As restrictions intensified, smuggling increased, supported by local brokers and middlemen who connected Western merchants with inland markets. These networks became indispensable. They negotiated, provided intelligence, and helped foreigners operate within complex political landscapes. Asia's geopolitical position compounded these challenges. Militarily, most Asian states lagged far behind Western industrial powers. Their naval fleets were outdated, their bureaucracies slow to reform, and their political systems divided by internal rivalries. Western countries possessed steam-powered warships, advanced artillery, and vertically integrated trading companies that combined commercial ambition with state-backed military support. The social impact was equally disruptive. Local craftsmen lost markets to cheaper imported goods. Agricultural communities faced new price pressures, and major port cities experienced rapid demographic shifts as laborers migrated toward coastal regions affected by foreign trade. These stresses fed broader conflicts. Diplomatic disputes turned into military confrontations as Western powers forced open ports, imposed unequal treaties, and claimed privileged trading rights. For the United States, which entered the region later than Britain or France, these openings created opportunities to expand its own commercial footprint. American firms established offices in Shanghai, Hong Kong, and Yokohama, integrating the U.S. more deeply into Pacific commerce. But the historical memory of forced trade and unequal treaties left lasting distrust, especially in China, shaping the trajectory of U.S.-China relations throughout the 20th century. And so, we're left with the uncomfortable tension. The same trade that fueled American growth contributed to political instability and economic damage in Asia. The question we must ask is not simply what happened, but who bears responsibility: individual merchants, nations, or the global system itself. This sets the stage for examining how these events were later recorded, reshaped, and sometimes deliberately forgotten. As America's commercial fortunes expanded through the 19th century, many of the families who benefited most began quietly reshaping the story of how their wealth was created. They shifted into new industries, founded banks and insurance companies, and rewrote the narrative of their origins, so the more controversial elements of their early trade disappeared behind corporate names, charitable institutions, and a carefully curated public memory. This wasn't accidental. It was a deliberate effort to transform mercantile profit into a legacy of respectability. Throughout the late 19th and early 20th centuries, these families sponsored historical works, funded archivists, and supported scholars who portrayed them as nation builders rather than beneficiaries of global power imbalances. By donating selective documents to libraries and destroying others, they shaped what future generations could access. Entire chapters of early American overseas commerce were softened or omitted, replaced by stories of industriousness, innovation, and the entrepreneurial spirit. Universities and museums played a central role. Endowments financed libraries, lecture halls, and scholarships bearing family names. Academic departments were built with their support. This institutional presence subtly reframed their past. The benefactors became icons of civic virtue, guardians of culture, and champions of American progress. Over time, these public associations overshadowed any discussion of how their wealth had initially been accumulated. For most Americans in the 20th century, this sanitized legacy became the default understanding. Textbooks emphasized westward expansion and industrial triumph, but rarely addressed the global economic dynamics that fueled early American fortunes. Media echoed these narratives, amplifying a version of U.S. history that looked inward and avoided the complexities of America's entanglement with Asia. As a result, the public inherited an incomplete picture, one that minimized uncomfortable truths. Yet archival evidence tells a more intricate story. Researchers today uncover contracts, shipping logs, and private correspondence, revealing a history far more global and morally ambiguous. This contrast between documentation and public myth has become a central theme in modern historiography, challenging long-held assumptions about the roots of American capitalism. The legacy of this early wealth still echoes in contemporary politics and finance. Many of America's leading banks, insurance firms, and investment houses originated from these merchant families. Their influence shaped regulatory frameworks, foreign policy attitudes, and economic institutions. The concentration of economic power across generations demonstrates how early global trade molded the structure of American capitalism itself. This history also shadows modern U.S.-Asia relations. Mutual suspicions, competing narratives, and unresolved historical memories continue to influence negotiations, trade disputes, and diplomatic strategies. The past is not distant. It lives inside current policy debates. And so the essential question remains: can a nation fully embrace its prosperity without confronting the global consequences that enabled it? Understanding this intertwined history invites viewers to look beyond familiar narratives and consider how power, profit, and morality have traveled together through America's rise, and what that means for the future of its relationship with Asia.